Okay. So I'll look at PDF and control. I think. Right. So you can see my slides. Cool. So look, this city is a new project, but it's almost finished, and we're going to submit it like very shortly. So we welcome really comments that you may have about anything that we may have missed, or we really always. I personally very much welcome critical comments because I always prefer to get them before we submit them from the reviewers. I very much like this project. It's a continuing project with Roma. Roma is my former PhD student. He was my PhD student at QUT, finished in 2015, and then after he did a postdoc at University of Sydney, and then a postdoc at NYU Abu Dhabi, where he is now. And I have a few of my papers recently have been with him. So this is a paper on market reactions to market prices reaction to information. And it's really a follow-up to the study we had published last year in Review of Economics and Statistics, when we looked at the outcome bias in the situation of football, where we look at footballers who try to score, and they hit the post trying to score. We're talking of soccer, and either the ball bounces off or in the goal, and then these situations are very similar, but they have very different outcomes. And there is a kind of regression discontinuity flavor. And we ask a simple question like, given that you take a lot of players and you match them, given the location where the shot was, and some are successful, some are unsuccessful, how are the evaluation by the coaches and the journalists differ? And we observe there a large effect of scoring versus not scoring, even if that's the only thing which differentiate them on average during a match. So here we take this data that we used, and we leverage on this nice quasi-experimental setting of having very similar performance leading to very different outcomes, to ask a totally different questions in another field, which I have worked quite a bit in, which is the efficiency of markets, this kind of markets, which are binary option markets, which are the type of markets that betting markets organize on these events. So I'm going to develop further in the introduction to, if you're not familiar, hopefully that's going to become intuitive. So the question we ask is, it's really an investigation of the efficient market hypothesis. The efficient market hypothesis says that the prices on a market, typically we talk of financial markets, the price of assets incorporate all the available information in the price. So the price reflects all the available information. So if a financial market is efficient, then the news are incorporated immediately and fully. So here what we're going to investigate is that we investigate whether asset prices on a betting markets react and how they react to the arrival of news. And we'll observe news, which is going to be the goals arriving in a football match. And we're going to look at betting markets, and they have bets and there are prices on these bets. And we ask, do these markets adjust efficiently to the arrival of this news or not? And in particular, there's a huge literature in finance, some of which was contributed by Richard Thaler in the 80s, on the over or under reaction to news. Richard Thaler wrote in, I think, 1982, an article saying that there's overreaction to news on markets. And since then, some papers have found like overreaction or underreaction to news in different settings. So when people want to look at the study the efficiency of market prices in general, and if you want to look at in particular, the over or under reaction of prices to news, there are several challenges usually. So one is that the fundamental value of the assets is unknown. So if you think about, you look at a stock and there's a news relevant for the future profit of the company, how this news should be factored in the fundamental value of the asset is not a trivial thing, right? So it would depend typically on how you think this news is going to impact the string of future revenue from dividends from this piece of stock, for instance. So typically, if you think about and also how the future prices are going to evolve. So the fundamental value of these assets on financial markets is not observed, and so you need to estimate it, or you need to have a kind of a control group to estimate assets which have similar values to, on average, to these assets, but are not impacted by the news. So, but there is a question here. It's not because this fundamental value is unknown. What you have also that the real timing of informational shocks may be hidden. So, you have a company and you have a news which is released, let's say, today at noon. You learn something about the profit perspective for this company. So the question is, when is the real timing of this news? I mean, like, okay, you hear, let's say this news is revealed on by Reuters or by, public announcement today at noon, but many other people had this information before. So, the question is that how large was the circle? Were there just a few insiders who don't participate in the market, who had this information before the public release? Or did you have already a kind of fairly loose circle of people who had access somewhat to this information? So you can typically have information leakage before the public information is released on the financial market. And so often it's not clear that you can identify exactly when is information released versus before. And this information leakage is going to make it harder to identify how price react to news, because some of the news may have already been incorporated in the price before the official announcements that you observe. Also, the timing of informational shocks is typically not random. So when a shock happens is not determined by a random device, by an experiment. So if you just take the random shocks occurring in the real world, you can't consider it as a kind of experiment where the shocks happen from nowhere. It may come in situations when you have, for instance, tensions, when the markets may be in situations where you're more volatility than not, etc. So that's another thing which makes it different from an experiment. So what you have is that in these markets, you don't have counterfactual to this information shock. So you observe an information shocks. Let's say this company stock. You learn something about the prospect of profits. Let's say you have an Australian company selling barley, and then you learn that China is going to set tariffs on it. So that's a news which is relevant for the prospect of the profits of the company, but you don't have the counterfactual. So you will never observe what would have been the price evolution of this asset if the news had not come. And because of the previous things, we see that the real timing is not known, the timing of the information is not random, and the fundamental value of the asset is not known. Because you don't have this counterfactual, you will need to use other things in the observational data to kind of have the equivalent of a counterfactual, which may be, for instance, a control group. So maybe if you look at a company selling barley in Australia, you may want to have a company selling wheat, because maybe wheat is not impacted by the tariffs, etc. But then the quality of your inference is going to depend on the quality of your counterfactuals. So as a solution to these challenges, one way is just to go outside of the financial markets, the field markets, and to do an experimental market in the laboratory when you control everything. So you control, the information that the traders have, and you control the timing of the information and the informational content of the information of the shocks. So that is great. Experimental markets you get a lot of very interesting insights, but they have their challenges. So one thing is that you have a small sample size, and you have you typically have markets of size of like 10 traders. So there's a question of like the external validity of making it or drawing conclusions from these markets to huge financial markets. And then there's the other thing is that the traders typically are students, often undergrad students, and so it's not clear that they don't have the same kind of financial experience as traders on a normal financial market. So there's a question here about whether if you observe some biases on experimental markets, these biases would be present in field markets where actually the traders are going to have like much more experience and will have their trades are going to be influenced by computer program, like complex computer programs or risk analyst reports, etc. Another solution to look at financial market prices to look at sports betting markets. So sports betting markets, they typically take the form of binary options. That's not the only asset, but typically it's a binary option. So binary option is an asset which takes only which gives you two potential outcomes. One, if a given event occurs, then you get a positive amount of money, and if this event doesn't occur, you get zero. And that's basically a bet. And so if you bet on a team, you are buying a binary option. So you're paying a price for a binary option, and the binary option will give you a lot of money, hopefully, if the event, let's say, if the team on which you bet wins, and it will give you zero if the team on which you bet loses. These betting markets, they have some nice features which are relative to the experimental markets. So first, relative to the field markets, you have a defined and observable outcome. So you know, unlike the stocks, when the value of the stocks depend on the kind of long-term flow of revenue that you can expect, but you know that's potentially forever. A binary option will have an observable outcome eventually, which determines what is the value then. And if you can then can pool a lot of binary options together, and you can compute based on observables the average value that eventually these binary options will have. So we'll use that, and maybe it's a bit abstract now, but we'll use that to estimate the average or the expected fundamental value of these binary options, because we observe the final outcome of these binary options. What you have in these sports betting markets, that traders are much more experienced than in experimental markets. And you have two types of traders roughly. You have the punters, which are just people who want to gamble. And they are not like financial traders, but already they have typically more experience than students going on experimental markets. But what you have on these markets, in particular the big ones, you have actually the equivalent of hedge funds. We use advanced strategies to use market imperfections and make money. And I know that as a fact because I was working, I have a few papers on sport, and I get contacted by these people who want to know about potential patterns that they could use to make money. And I know that they're able to make enough money to pay the wages of a few people working on these markets. And another advantage of these markets related to experimental markets, they have high liquidity and they have a high trading volume. So that's much bigger. It's kind of an intermediate in terms of, if you think of it, it's an intermediate between the experimental market and the field market. We retain some of the advantage of the experimental market. So that's an interesting setup. So what we're going to do, we're going to use sports betting market. And we're not the first one to do that because of these features, other people have used them before. One of the closely linked paper is by Croxon and Reed in the EJ in 2014. And they look at this market reaction after the arrival of a goal in soccer. And so they look at the Betfair data, which I'm going to describe afterwards. And they just ask a simple question, like when you have a goal in soccer, what happens to the price of the bet? So what's interesting when you look at the price of a goal is that relative to a field market, the informational shocks timing is unambiguous. So unlike in the field markets, when I say that you don't know whether some people may have access, there may be informational leakage before the public release of information. Allegedly, if a match is not skewed, if there's no cheating, then people can't predict the arrival of a goal. So people don't know before. Nobody knows before the arrival of a goal that a goal is going to arrive now. Or if I would say nobody has inside information. So that's the goal arrives, and that's where the news happen. Then they look at how the price updates after the arrival of a goal, and they observe that the price updates immediately after the arrival of a goal. And their strategy is to look at goals which happen just before the halftime. So they have a fairly small sample size, I think from memory, something like 50 or something matches. And the key is that they look at just before halftime, because at halftime the match freezes. In some ways, you have like 15 minutes when nothing happens, and as the match is stopped, and so the time passes in real life, but the time doesn't pass in the game. And when time passes during the game, then actually every minute is an additional bit of information, because let's say if a team leads 2-0, every minute passing means that this team is more likely to win versus another type of outcome like a draw or a loss. So when you're outside of a halftime, time is informative. But when you look at the time during halftime, the game itself is frozen. And so they can look at how the price evolved, even though no new information, allegedly, is coming onto the market. And so the main result is that they find no drift after the initial date. So you see, there's a goal happening just before halftime, the price changes quickly, and then during halftime, the price stays flat. And that's interesting, because when you have if you had underreaction or overreaction, usually you would expect that, for instance, if you have an underreaction, then as time passes, initially the price jumps, but then the price would drift upward afterwards as an indication that the initial jumping price was not high enough. There was an underreaction, so the price continued to adjust with a drift afterwards. And so Croxon and Reed didn't observe any drift after the initial date. So our contribution is we blend the betting market and experimental market approach somehow. We are going to explore these quasi-experimental variations in informational shocks in a betting market. And we look at a setting when we observe counterfactual situations. So we are going to look at these shots on goals where some goes in and some don't go in. And we are going to use the shot going in as creating an informational shocks. There's a goal, and the shots going out as creating no informational shocks, there's no goal. But they are going to be counterfactual, because an informational shock could almost have happened. And as happened, there was no informational shock, but they are very comparable situations. And we're going to be able to estimate the asset's expected fundamental value in the two situations and to compare them, and to use that to compare, to measure if there are abnormal returns one way or the other. So in practice, what we do.
Can I interrupt and ask a question?
Sure.
So can you describe the structure of these betting markets a little bit more? I mean, because if you can still bet at the same price on a game toward the end of the game, well after half time, then you're greatly advantaged by comparison with someone who bets at the beginning, right? So the question then is, what kind of betting arrangements are made? Normally, as I understand it, if you bet later, the payoff will be smaller, right? So that if you bet earlier, the payoff could be higher. So in a sense, the timing during the game represents a set of different markets.
Look, that's a very good question, and I'm going to describe in detail what this market look like. They are really so they are not looking like the way you describe, and I think when I'll describe it, it's going to be very clear how it works. So effectively, the timing matter a lot, but the timing will be factored in the price of the asset. So, I mean, in some ways, you're right that if you I will show that as the time passes, you have less and less potentially uncertainty in the outcome. And so the potential for gains is going to be less. Well, I think the best is that I think it's in one or two slides. So I'm going to describe how they look like.
Okay.
That will address your question.
Okay, we'll wait for that. Yeah, okay.
So what we are looking at, and I've said that already, so I'm going to do it quick here, is that we look at soccer players hitting the post while attempting to score. Sometimes the ball gets in, it's a goal. Sometimes it goes out, there is no goal. And for shots taken from a similar location on the pitch, so the data we have, we know where the shot was taken on the pitch. And so we're going to match players shooting and scoring, to players shooting and not scoring, but they took a shot from a very close location. And in practice, it's going to be around a half a meter away. And so we argue that when you take these two different situations, whether the ball goes in or out is as good as random. And by that, we just mean that whatever makes that a goal is in or out, there's no substantial correlation with the outcome of interest. That is, here, if you look at whatever could influence the market prices on the market, whether a goal goes in or out, whatever the factors, which can be tiny, lead a ball to go in or out, are going to be unrelated or not substantially correlated with the factors which influence the markets, whether the abnormal returns should be higher or lower. This is the same identification strategy as Gorio and Page in our restart paper from last year. And in this paper, we show that effectively when you match the papers, the shots, based on whether they go in or out, you look on the balance on a wide range of observables, and you don't see any difference. So really, the players look at the same quality, the market values of the team is the same, etc. The type of position they have is the same, etc. And if you want to see more about that, if I have the time at the end of the talk, I have the balance test. And so what we look at, we observe the Betfair exchange trading in play on contracts, and we are going specifically to tend to focus, not just, but mainly on the contracts of the form team A, whatever this team, will win. And I'm going to describe shortly after I'm going to give you the findings, and then after I'm going to describe the data. So the main takeaway that we have from our study is that most of the time, the prices are efficiently integrating news. So that means that we observe that after a goal is scored, the price adjusts accordingly without under or overreaction. And that to us was a bit surprising, given the literature, which tend to find underreaction usually, sometimes overreaction, depends on the settings. And also the fact that, if you think that betting markets are, because you have the punters are not professional traders, there are lots of emotions, you'd think that maybe that's the kind of markets where you could have some deviations, like maybe, for instance, overreaction. And we didn't find anything. So it's not true that we didn't find anything. We find that most of the time, the prices are really efficient at integrating news. But we still find underreaction in some cases. And in practice, it will be when the informational shocks are large. So it's going to be at the end of the match, when you look at the last 15 minutes, and when the score moves from a situation when you're a draw to a winning situation, we'll observe that the price tend to underreact. And we'll have some discussion about what's the likely reason for it. So I'm now going to describe the data, and as part of it, I'll describe the market, how they work in practice. So we have two types of data which we merge here. We have the data from the football, which comes from the Opta, which is a company which collects the data on football matches. So if you watch TV and you watch football match on TV, all the kind of data analytics which is displayed, with graphics during the match or at halftime, they typically use Opta data. I'm not sure Opta is the only company, but it's really one of the big company providing data. They have people coding data live during matches, and that feeds the database. And that database is used by TV companies, etc., to create infographics. It's also used by coaches, etc. So there's a lot of, it's very valuable data, and it was very hard for us to get it. It's very expensive. Opta sells this data to media, football clubs, and academics. And so we had to pay quite a bit of money to get it. What we got when we asked the exhaustive list of goal opportunities where the ball hits the post. And we just asked that. And then what we want is to know the minute that happened, the player who shoots, and the coordinates of the location where the shot was taken in the field. And then we match this with lots of publicly available information on the matches, on who are the teams, what are the players in the teams, and what are the standings of the team, etc., etc. The data we got is a data set of several thousands of matches taken from the 5 major leagues in Europe. The Bundesliga in Germany, the Ligue 1 in France, the Premier League in England, Serie A in Italy, and the Liga in Spain. And you can see here that we have in total 7,000 matches. So a post doesn't happen in every match. So there are some matches without posts. So we observe post only that amount of post situations, which is a hit on a post. So we observe 4,000 situations where a ball hits a post and bounces out, and 970 situations where the ball hit the post and bounces in. You observe an asymmetry between two numbers, and that, I mean, we're not specialists, but if you think a bit about it, it seems very intuitive that if you think of the geometry of a goalpost and the different angles from which a ball can hit the goalpost, most of the angles, the majority of the angles a ball would hit the goalpost would lead the ball to bounce out, and only a minority of angles would lead the ball to hit the post and enter in. So it's not surprising that you have less post in than post out. Note that this post, we don't just take one post per match. So, you know, this post may be concentrated in a bit less, fewer matches than 4,000. So here's the data, which looks like if you just plot the post, the location of the shots where they were taken, and the blue dots represent the shots which bounce off the post, and the red dots represent the shots which hit the post and goes in and you score a goal. And so what we were going to do typically is we're going to take situations like here when you have a red dot and a blue dot, and we're going to use, for instance, if you take the red dot, there's an informational shock, there's a goal, we're going to take the blue dot as a counterfactual. In practice, we're going to do local averaging, so we're going to use several blue dots as a counterfactual of the red dot, but that's really the idea, is to use this kind of local matching. And now I can answer the question about the markets and how they look like. So we use the Betfair data. Betfair is a company which manages the largest betting exchange in the world. They have, so we take that from their website. So they have over 4 million customers, and they have a turnover of over $66 million per week. The betting exchange allows traders to bet on the outcome of the match. Like the bet can be, for instance, team A will win. And the traders can buy or sell the bets on the outcome. Betfair is really a market, but because it talks to it's a British company which kind of competed with bookmakers. Really, Betfair is a financial market which looks like a betting site, which is very comparable to bookmakers' site. So it uses the terminology of bookmakers, but what they do really is creating a financial platform. So Betfair doesn't talk about traders, they talk about punters or bettors, and they don't term they use buy or sell, they use the term backing the outcome, laying the outcome for the bets, backing the bets, laying the bets. So that's the term they use, but really what we have is that people are trading here and buying or selling assets. So if you go on Betfair's website, that would be typically what you would see. So here's a match, for instance, between West Ham and Huddersfield. You have 3 potential markets for this match. West Ham will win, Huddersfield will win, or you will have a draw. And then here you have the prices that you can decide to back, which is to buy, or the price to lay. And you can see here that you have the orders, the different orders, and here you have the 2 price, which are around the bid ask, and the difference between the 2 would be the bid ask spread. How do we read this? Well, if you want to buy the bet, if you want to buy the asset West Ham wins, which so you would bet yeah, so at the odds of 166. So if you bet $1, you'll win 166 if West Ham wins. So that your net gain would be, so we'd pay $1 here, and you would win 166 minus $1 is 66 cents. But if West Ham doesn't win, then you lose $0. You win $0, so you lose your $1. If you lay the bet, you sell the bet, West Ham wins for at the odds of 166. If you get $1 for selling the bet, but you lose 166 if West Ham wins. So you would have to pay the winner of the bet, which is the person who backed the bet. So you would lose. You sell the bet, you get $1 initially, then you lose $1.66 because the bet was unsuccessful. So you lose 66 cents. Sorry, get $1 and lose. I'll lose $0 and keep the $1 as was. Ah, yes. If West Ham wins, you lose, and otherwise, if West Ham doesn't win, then you keep your $1 and your net gain is $1. So that's the way. In spite of this framing, really, what you're selling is this kind of binary option, which is you pay $1, you get $1 initially. And the assets that you get eventually, the value that you get is going to depend whether the asset is the event happens or not. So it's a binary option. So once you pay $1, you're here at this price of 166. Your binary option is going to give you a price of 66 cents if you're successful. And here, when you sell it, you are not going to lose 66 cents in net value if you're unsuccessful. So even these markets is presented as a betting site. Really what you're getting these binary options when you can buy and sell an asset, and the final value of the asset is going to depend on the occurrence of an event or not, which is here the match results. Right. Are you familiar with this kind of market? So do you have questions about them?
I want to follow up a little. I'm not really familiar with this, but my presumption is then that these prices are dynamic through the course of the game. That is, if it's 1 minute before the conclusion of the game, then I'm not going to get 66 cents if I win. I'm going to get something less, presumably. So otherwise, nobody is going to sign up to make a bet before the last minute of the game. Right? So
you're totally right. So if you go on a bookmaker website, the odds offered by bookmakers tend to be a bit rigid. So they are before the match starts. You have these odds, and not much information is here, and they are quite fixed, these odds. But this is a market, so these prices are actually what traders offer. So if you register on Betfair, you can come here, and as the match moves, you can offer to back or to lay, and to be a backer or a layer of these odds. And as the match outcome change, then these prices are going to change. And I'm going to give you an example with a graph you will see. And one of the big advantage of Betfair is this flexibility during in-play, and most of the exchanges are made in play.
But if I could just follow up, then what that means is that if I make a bet before halftime, the price of my bet is the same all the way through. My question then is it totalized in some way so that the price of my bet actually changes, even though I bet at a particular time early in the game?
Oh, I see what you mean. No, Lucas, that's a good question. At the time,
my particular bet, does my price stay the same? And anybody who bets later, their price will be fixed at the moment.
Your price is fixed at the moment you buy the bet. Good. Which is it's really like the way when you have like binary options, you have real financial markets with binary options, and they work exactly the same. That is, it's a gamble at time t. At the given time, given your information, you're willing to make this gamble, and then this gamble is fixed. So obviously, you yourself may not be willing to make the same gamble 10 minutes later. You may prefer gamble, but you will have in your portfolio these binary options booked at this price.
Right.
And most of the money made by Betfair and most of the exchanges are made in play. You can see that the volumes are huge because you have huge liquidity on this market, and bookmakers cannot do it because bookmakers have these they have to make up the price and to give a price to make their mind about what's the best price possible. And the risk for bookmakers is to offer you a price, and then suddenly a goal happens, something happens, and then the price they offer you doesn't reflect the real chances of the event, and then you could take an advantage of the information coming to gamble. So bookmakers, the way they work is not very suitable for in-play when you have lots of information coming very quickly. Bookmakers typically work better when you have like before the match happen, no information is coming, so you can go on the website, the price of the bet is fixed, etc. Well, Betfair is really a financial market where Betfair removed the intermediary between, the bookmaker really is an intermediary between people who want to back one outcome and people who want to back the other outcome. Betfair removed this intermediary, creates a betting market where people can offer the price in a double auction setting. And so this is going to be the market price. You can see that the market price, if you take it, the midpoint is 1,665. And this market price is going to change very dynamically as the outcome of the game change.
Just a clarificatory question, Lionel.
Yeah.
So you're saying that Bookfair is over-the-counter kind of a market, while Betfair is kind of an exchange. Is that right?
I'm not sure what we say is over-the-counter. I'd say it's the bookmakers work as intermediaries between people who want to back one and the other outcome, and they set the price. So the bookmakers are setting
and they're
prices.
not acting like a clearing house, right? So Bookfair is not acting like a clearing house.
Well, that's an interesting question. I mean, in theory, if they are risk neutral, if they are risk neutral, if they are risk seeking on the contrary, if they are risk averse, if they are risk averse, they should act as a clearing house because that's a way for them to make money without taking risk. That they just give odds which reflect the balance of bets on one side and the other, like that they have balanced book, they don't take any risk. If they are risk neutral and they think they know better than the market, they can actually not fully balance their books because they think that one side is more wrong than another. For instance, I'll give you an example. In England, you have lots of people who tend to back the national team to win the World Cup. Bookmakers may not decide to balance the book, thinking it's less likely that the England team is going to win than the English gamblers are thinking. So, maybe the odds to balance the book would be, let's say, 1.8, saying that England has more than 50% chance of winning, but they don't think they need to do that because they think it's so unlikely that, they could offer an odds of 2.5, which is already more than the actual chance that England is going to win.
So bookmakers are setting the price in effect, obviously taking all information into account, but they are setting the price. While in the case of Betfair, it's more the participants that are deciding what the price of a lay or a back is, right? Exactly.
So in Betfair here, it's you registered. If you have lots of money, for instance, on this market, you could say, I'm ready to back. If you think, for instance, that the event is very likely, you would be willing to back at a low price. You would be willing to back at this. If you think it's almost sure, let's say you had insider information, you know that West Ham is going to win, for instance. Well, you would take any price. So you could put an order of here you see there's $3,971 willing to be matched. But you could say, I have $10,000. Give me anything for $10,000. So you would say $10,000 at 1.6. You would buy all these, and then all this, and then all this, and maybe a few at 1.63. And then you would have moved the market price. Typically, you'd see the market price move like that.
So Betfair is in fact exchange.
It's an exchange, yeah. And so you don't have intermediaries. So the rational expectation equilibrium price of a bet reflects the probability of the outcome given the information held by the traders. So if the markets are efficient, then the price should really be a reflection of the probability of the outcome. Because if it was not, you may think, intuitively you may think there would be arbitrage opportunities. So if you know the probability and the probability is different than the price, then you can gamble and make money. We can make arbitrage. Okay. So the situation without arbitrage is a situation where the price reflect the probability of the outcome. And what's the relationship between the price and the odds is very simple. The probability implied by the market, for instance, on the case of West Ham, it's 1 divided by the odds. So if you see an odds of 166, it implies that the market kind of estimates the probability that West Ham will win at 60%. And if the market is efficient, then the odds should reflect this actual kind of probability, given the information. So given the information at time t that traders have, the probability should be 60% that West Ham will win. So what we're going to do is, for simplicity of presentation, we'll use this probability throughout the discussion as the underlying price of the bet, because there is this relationship, this 1-1 relationship between price and between the odds and the probability. And you can think of this probability simply as a price of the ROW asset, which gives $1 if the outcomes happens, and $0 otherwise. So you could think of any bet. You could replace any bet by kind of some number of RWs, maybe a fractional numbers of RW assets, where an RW assets will give you $1 if West Ham wins, $0 otherwise. And so buying a bet is something like buying 1.5 RW assets. And so we can use this price here as a price of the RW asset. And we're going to use this all throughout, like that we can normalize all the prices that we see between 0 and 1. Do you have any question? Okay, so here's then, if you do that, once you transform the odds in probabilities, it gets more intuitive than the odds. I always find the probabilities more intuitive than the odds. So let's look at this game here. You have Nuremberg. I don't remember which opposition they are playing against, but that's a match in Germany and Nuremberg is playing. And so we normalize the price of the odds between 0 and 1 by taking the inverse. And then you can see right away what the market thinks, what's the most likely outcome. Well, you can see that Nuremberg is kind of above 50% chance of winning to start with. So Nuremberg must be a big favorite, because remember, there's 3 possibilities. There's winning, drawing, and losing. So having more than 50% chance of winning means that you're really a big favorite. Because this probability is divided, the remaining probability is divided between losing and drawing. Then what happens is at minute 28, there is a shot on goal and the ball goes in. So you have a post in, and you can see right away a jump in the probability of winning, the probability inferred by the market. So that's really the price of the market reflect this increase in probability. Then as time passes, nothing much happens initially, but time is information. So eventually, as time passes, you can see a drift upward, which reflects the fact that eventually, if Nuremberg is 1-0 up, every minute passing makes Nuremberg more likely to win the match if nothing changes. Then you have around minute 70 or just before minute 70, another goal. There's no post, but the opposition team score a goal. And then you can see that suddenly the probability of winning decreases a lot. Now it's less than 50% because you have a situation when you have 1-1 with only something like 20 minutes left to play. So, Nuremberg could lose, Nuremberg could draw. The probability that they win is now around a third only. Now what you have is that the time passing, you see the drift, because as the time passes, winning becomes less and less likely. You have at minute 70 a shot on goal, it hits the post, but nothing happens, and you can see the price doesn't bulge. And then minute 85, Nuremberg scores a goal. So they become 2-1 up, and now they are very likely to win. And then the drift is upward, because every minute which passes makes it more likely that Nuremberg is going to win. At minute 90, just before the end of the match, there's another post shot on the post. The ball is out. There is no effect on the price. And then the price converges towards 1 at the end. And so I think, you know, Rod, you were mentioning how things evolve across time, and you can see how here the price dynamically really reflects the full information, and part of the information are the goals, and part of the information is the time passing, which reflect these tendencies, you know, to go toward the extreme. So if the current outcome is no, then the price is going to decrease as time passes, and if the current outcome is yes, then the price is going to increase going towards 1. Okay, so because we observe these the final outcome of these binary options, one thing that we can do is then we can look at we can use the observed frequencies of the outcome as a way to estimate the expected fundamental value of these binary options. So that's one of the big advantages of these binary options, that you can use a large amount of data, and if you condition on some observables, condition on these observables, you can say, okay, in practice, condition on these observables, that's the actual probability or the actual frequency of how often this outcome has been positive. So the price on average should not systematically deviate from these observed frequencies. Otherwise, there's a problem. So we call that the calibration of the price. And here we do what we call a calibration curve to study whether the price is good. And basically, we ask a very simple question. If markets are right, one of the first things that should happen is that for a given price, the observed frequency should be equal to this price. That's the most basic test that these markets are well are not biased. So if you buy a bet at 20, then 20% of the cases should be successful, and on average, 80% of the cases should be unsuccessful. And symmetrically, if you buy at 80, then 80% of the case it should be successful, and 20% of the case should be unsuccessful. So what we do, we run a non-parametric estimate. So this curve, the bold curve, is a non-parametric, a local linear regression across the frequencies. So the data that you don't see is like, you know, the dots, which would be 1, 1, 1, 1, 1, 0, 0, 0. There are tons of them, and then we just estimate the local average of these frequencies. And what we can see, and you have the confidence interval of this curve. And you can see that the frequency, which is the actual empirical probability, is very, very close from the price itself. So this market is very well calibrated. I have worked quite a bit on this kind of markets. I have this paper in 2013 with Rob Clement on markets, and we were using another data set from TradeSpot, and there was a bias on this market, not big, but this is much less biased than what we've seen. If you look carefully, you can see that there's a bit of an S shape on this market of this curve. And this A shape is characteristic of what we call a long short bias on betting markets, which is that the prices for things which are long shots, which are unlikely, are worse than the price of things which are very likely. People like to bet on things which are unlikely, because if you win big. And so this price is actually worse. So if you buy at 20, on average, the empirical frequency is a bit lower than 20. So you tend to lose a bit money. It's not significant in our stuff, but you can see that the curve tends to be a bit below 45-degree line. On the contrary, if you buy at 80, the empirical frequencies tend to be a bit above. And so this S shape is characteristic of the long shot bias, which is very common on betting markets. But this long shot bias here is very, very, very small. Please let me know if you have questions about this. So what Betfair does to protect punters, traders, is, people put orders on the market, but when a new information come in, one risk is that people who are very quick or have access of quick servers or maybe automatic programs to trade could use the dormant orders, pegged orders at some prices and make a lot of money. So imagine, you're just a normal punter watching TV, and you go online and you put an order, and then you watch a match, and then the goals happen, and the time for you to go back to your computer and change your order, maybe, I don't know, even if you're quick, maybe it's 1 minute and 30 seconds. And you could imagine somebody running an automated trading system could incorporate right away the news coming that there's a new goal, issued orders, and take advantage of that to match your order and buy your price, which was based on prior information, and then make advantage of your, let's say you think that West Ham is very likely to win, so you buy, you propose a price that West Ham is going to win, which is pretty good. Then the other team wins, and then this automatic trader could come and just buy your order, match your order before you could remove it. So that would, if it was the case, then traders would be reticent to take the risk of putting their orders on the market. So what Betfair does is that it protects you by freezing the market and clearing the book of orders after a goal. So when there's a shock, it prevents, it assumes that all the previous spec orders are kind of irrelevant now. They are based on previous information. So all that are removed, and then the market restarts 30 seconds afterwards, or between 30 seconds and 2 minutes. So yeah, that's what I said. So what we're going to look at here is we look at the effect of an informational shock on the difference between the expected outcome and the expected probability implied by the market. So, and why do we do that? We do that because if you consider what is the return of buying the asset, the return of buying the asset is going to be the difference between the outcome, which is going to be 1 or 0, and the price, which is something between 0 and 1. So if you buy at 60, for instance, 0.6, you're going to make a return of 0.4 if the match is, if your bet is successful, and you're going to lose 0.6 if the match is unsuccessful. And so what we're going to do to look at this difference between expected outcome and expected probability implied by the market, which is the price, and that is we're going to compare. This is going to give us a return of buying the asset, and we're going to compare this return of buying the asset whether there's an informational shock or whether there is no informational shock. We're going to compare this return if the post is in and if the post ends up to the ball going out. And that will give us, so normally if the prices are efficient, there shouldn't be any difference. So there shouldn't be any abnormal return. That's a characteristic of an efficient market. But we're going to look at this difference to see whether there is some abnormal return, in particular whether there's more positive abnormal return when the goal is in. Positive abnormal return would mean that you have an underreaction. That is actually, given the price you pay after a goal, the probability of the outcome is even bigger. So the price didn't fully reflect the increase in probability. That would give you, an underreaction would give you positive abnormal return. And an overreaction would give you negative abnormal return. That is, after a goal, you would pay too much to buy the asset, and eventually the price you paid is higher than the actual probability of the event that you buy. Then what we're going to do is
could I ask a question there?
Sure.
I'm a bit curious about, when you say you have large amounts of data, you're using these large amounts of data to calculate what the actual probability of the event is. I'm curious as to what that means, because if you follow one particular team, if this true probability is obtained, or the estimate of it is obtained from a time series for all matches between West Ham and some other Premier League team, then history is not always the best guide to what will happen today. I mean, West Ham in some earlier point may have been much stronger than it is now, or vice versa. So the question is, how much store can you place in these empirical estimates of what the true probability is?
So, look, there are, it's a deep question about what's the probability, and I think what's the answer here is that we're only when I say that the price reflects the probability given the information of the traders, I have in mind a setup which is a simplistic setup. But let's say that you have traders. Let's say Bayesian you have traders that are Bayesian. They observe signals about the real state of the world. And let's say the state of the world is West Ham wins, And if you were to aggregate all their signals, the price should reflect the full posterior of all their information, which is shared among traders. So this probability, so if you have, in your case, if you have some traders that have much more information because they have been following WESAM for many years, then maybe the price should be better. You could think that some markets where there's a new team and there's not much historical information, then the price would be closer to 50% because there's actually less information available out there to be incorporated in the price. Where in the price, when you have an old team, when you have maybe expert traders who have some expert knowledge about this team, then they are able to convey more information in the price, and then the price will be more informative and would tend to be closer to 0-1.
Obviously, I understand all that, but what you have here is outcome versus a true probability, some estimate of a true probability. You're comparing what the market price is to what you think is a true probability, and I'm just wondering how you actually get that.
So I think what we look at is really we look at conditional probabilities. So when we look at this, and I say it's calibrated, this is not a proof that the price equals the probability because we don't observe the probability. It's kind of it's a more modest claim, is that conditional on the price itself, the price is equal to the outcome being conditional on the price. So we have to condition on some observables, and the only thing we can say is that conditioning on some observables, which can be the price, and we can also condition on the timing during the match, or maybe the goal scoring situation. Conditioning on its observables, we can observe whether there is a mismatch between the empirical frequencies and the prices. We cannot test as such the idea that the price fully reflects all the information, because that we don't know. We can only test whether conditional on some observables there is a mismatch between the average outcome and so.
Okay, I understand. Thanks for that. Yeah.
So that's what we do. We look at the abnormal returns between the post-in and post-out in two situations. So we're going to match observations to observe the potential value of the return if the outcome of the shot had been different. And I've said that before. We use a kernel matching estimator. So the way it works, I'm not sure if the equations are very intuitive actually, and I think I'm a bit late already. So I'm going to show you the graph. It's easier to see. It's like, let's consider this observation, and let's think that this is a situation when the location on the pitch of a footballer who hit the ball and the ball hits the post and goes in. So there's a goal here. And let's say that the circles are situation when a footballer in another match in a nearby location hit the ball hits the post and goes out. Then when we want to use these circles as counterfactual to estimate, we are going to observe the return, the evolution of the return in this situation. We want to use these other markets and the return that we're going to observe in these other markets as a counterfactual for this. And the kernel matching is very simple, is that you have different type of matching. One could be the nearest neighbor. So for instance, we just use this observation as a matching, but we can use more information by just using a local average, and you give more weight to the nearest observations. So the kernel, you have a kernel function, which is going to be just something which takes higher value nearby. So these are higher value here than these further observation far away will have smaller weight. So you'll have a local average, and the size of these circles represent the weight given to this observation. So the local average will be more informed by the closest observations to estimate a synthetic. So we'll have a synthetic counterfactual. So we will compare this return to a local average of return of these other situations.
Lionel?
Yeah.
Do you observe what type of shot each of these shots are? Because I mean, if you try to lob the keeper versus if you do a Roberto Carlos, I mean, they're very different. That's going to result in very different probabilities of them coming off the post.
Yeah, look, it's a very good question, and no, we don't. So the data set was very expensive, and as part of the negotiation to make it within our budget range, the only thing we said is that just give us whether the ball hits the post, and so we don't have any information. I'm not even sure. Opta may have this information. I'm not even sure that that, you know, something like a lob or, you know, this, I know that Opta, for instance, doesn't have trajectory like hawk eye, you know. In tennis, you have these trajectory, or in cricket, you have the trajectory of the ball.
Yeah.
Opta doesn't have that as far as I know. I think they have more information in terms of the location. If you have a penalty, for instance, they could tell you which part of the goal is the ball went in. Yeah,
fair enough. I mean, just two very quick comments then. One is cricket would be quite a good sport to look at here, because you can basically have two identical balls, both of which should have got the batsman out, but one was counted by the umpire and one was not. So I mean, that's a really nice counterfactual. Here, if you're going to do some kind of matching estimator, there's always the fear of unobservables. But if you've bought the best data you can't really do more than that.
Look, you're totally right, and I think when we worked on it for a restart paper, what we find is that when you match on close location, basically you have a balanced observables, but but when we don't match, for instance, like we observe some residual differences on observables, so we have to match closely to eliminate all significant differences on observables. So now,
can I ask a quick question?
Sure.
Suppose you have a goal from a position which is otherwise really unlikely to score a goal from, and so you don't have any neighbors to match it with, like the ones that hit the post and come out. Then you're weighing that less, but that might have a lot of information about how skilled the player is or how likely the team might be. And that is Chris's point.
Sorry, case in point being the goal that was scored from the halfway line in your data set. I mean, was that Beckham? Does your data set go that far back? But yeah, there you go.
So I can say that in our data, we have a bandwidth of 0.6 meters. So which means that this point, for instance, is not matched with anything. Likely this point is not matched with anything. This point is not matched with anything. So,
but that's a problem, right? Because they will convey a lot more information about the skills of the team.
I'm not sure. I would say it's a problem. I think what you want is that, you know, we have to. I mean, I think in terms of local average treatment effect. So I only want to say something about some things for which I have a counterfactual. So because I can only say something clean about something for which I have a counterfactual. So that's why these ones are clearly, I can't find a reasonable counterfactual. So I don't look at them, but I look at all those for which I can find a counterfactual.
That's a fair point. Yeah. Thanks.
Okay, so right. So if we compare what happens between the post in and post out, we look at the first price, the first transaction after the goal or after the post, and look at what happened. And we do the same calibration curve when there is a goal and when there is no goal. And overall, if you look at it, the confidence interval are larger, and that's to be expected because obviously we're splitting the sample and we're looking at much smaller data set. But overall, we don't find huge bias. If you look here, it looks like the curve maybe is a bit above when the post is out, but there's no significant bias. It's not significant thing. When we do the matching, we can do the difference in return, matching each observation one by one, and we can look at this difference as the time passes. And we observe that the first price observed is a bit positive, which could suggest a direction, but it's not significant. And this is how the difference in returns between the goals and the no goals evolves. You can see that it's very, very close from zero. So if we just look at that over the whole match, there is really no evidence or no strong evidence of over or under reaction. To us, if anything, it was a bit surprising given the literature and given that you think that the literature often emphasizes behavioral explanations. And, you know, it's very intuitive that if you think of the kind of Schiller irrational exuberance type of explanation, that news come in and people are excited, exhilarated, whatever, and that creates overreaction, for instance. And if this behavioral explanation is to have some bite on standard financial markets, if there is a market when you would expect maybe to be even more observable is betting markets, where, you know, you have like the outcome is football, there's lots of tension, people care a lot about things. Maybe traders are a bit less sophisticated than traders in financial markets. So to us, it was quite surprising that we don't find really deviations in terms of abnormal returns between the two situations. But what we can do, we can look at more and more sub-situations by conditioning a different type of observables to see whether the market is well calibrated and react well to information in many different situations. So we look by timing, and here overall, and here depending on whether the post is out or in. And here you see that when the bull, that the first half, the calibration is really, really good. The second half, the calibration, you can see an S-shape a bit forming. And in particular, when you look at the end of the match, then the miscalibrations become significant with this S-shape, which is symptomatic of a long shot bias. You can see that here the 45-degree line is out of the confidence interval. If you look now at the post-out versus post-in, you can see that actually the bias increases in both cases. It's not clear whether this bias is clear, but maybe this curve could look a bit above this one, which would mean that if you buy after a goal here, if this curve is above, then you're making more money here than if you buy after the post is out. And if you make more money, then you will give post. It would mean that you have more under reaction in this case than in this case.
Lionel?
Yeah.
Sorry, I know you've got little time. Quick question. I mean, I know very little about behavioral economics, but I thought it was the case that in terms of on horse racing, betting, people have a reference point at the end of the day where they started. So there's a tendency to bet more towards the end of the day. Football matches are often all scheduled at the same time, but if you're really into football markets, you're likely to be betting on lots of them all at the same time. So there might be a few that you're definitely losing on, which gives you an incentive to bet more on those that you're more likely to win on towards the end of the match in order to hit that reference point.
It's interesting. It's an interesting. So I know there's this paper about the end of the day effect. It's hard to map this with the football because the football. I mean, typically people would bet in their league. Sometimes the matches are just a standalone match in the day, and sometimes, like particularly if you're like Saturday night, you may have like plenty of matches going together. It's not clear to me how it works. My feeling, I can't give you a definite answer, but my feeling is that these markets are much more efficient than because you have these big actors playing. I'm not sure they would be. Right. I'm not sure there would be much of this kind of bias, and I guess I would have to give it a bit more food to be able to answer.
I suppose the question is whether you can. I mean, in my mind, it's not these big companies or these big players betting. So I mean, that's a failing on my behalf. I suppose what would be nice is to know if the same person betting is betting on one match or multiple matches at the same time on the same website. But sorry.
So that we don't know because the data we have from Betfair is just a market level data. So we don't have the trader level data. We don't have the transactions. So now we look at
just a follow up on that. Yeah. Do you have data on the actual volume of the bets in the course of the match?
Oh, not the volume of the bets. We have the volume. Okay. So we have the volumes of the transactions.
Yes.
So we don't have the idea of the transactions. We have the price and volume of the transactions, and we have some results on that as well.
Yeah. So is there a tendency for the volume to increase in the course of the match, or?
Yeah. So what you have is that's the volume is much higher toward the end.
Right. Good. Thanks.
So here's the price reaction in the first half. In second half. Sorry. Yeah.
So sorry, Lionel, just real quick. But going back to Chris' point, what you could do is you could go back and see which games were at the same time. So you could see whether one event in one game would affect betting in another.
That's a good point. Yeah. I'll put that down. That's a good point. That's trouble. We have the time. Okay. So here's a price reaction for the different timing. And you can see this is borderline significant, but actually, I'm not going to comment that because it's not robust to multiple testing because obviously we're doing lots of testing here. So I'm not going to talk about this one. But what you can see in the last minute, what the non-parametric curves were suggesting is significant here. And that's robust to multiple testing is that what you have is that you have a positive return, a higher return for buying after a goal than for buying after a post without a goal. This return here is like, between around 5%, and it's significant. So when we look, we can split even more. It doesn't last long though. If you look at it, it doesn't stay significant for very long, but there is an underreaction in this case. Now we can split not only by timing, but we can also split by scoreline. And obviously, the more we split, the more we increase the confidence interval because we split the data set. Also, what we do here, we are going to control for multiple testing. So all the results here are controlled for multiple tests to make sure that we're not just having 60 tests and 3 of them happen to be significant by chance. So when we do that here, we find significant interaction in 2 types of cases mostly. And these are at the end of the match when a goal changes the outcome of the match. So this is the team hitting the post is trailing. So for simplicity, we have put all the interaction in the direction of buying in the sense of the news. So if you hit the post, if you buy, buying in the sense of the market. So if you buy, if you look at the market, team B wins. This is an interaction of selling this thing after the post. So you have a post, and so basically this asset is losing value. The normal reaction would be to sell the asset because team B wins, the asset has lower value. And you can see that there's an underreaction in the sense that you will make positive returns by selling the asset. The asset actually is worth even less than the price at which you're going to sell. And in the same way, the draw here is become less likely than there's a draw because team A is trailing by 1 goal. By hitting the post, if they win, if they score a goal, then now they reach a draw. So that's actually a positive news. That's a negative news. And what you see is that this situation is a situation where the goal is going to change from you're trailing to a situation when you're a draw. And so the main 2 markets affected are you're less likely to lose and you're more likely now to draw. And maybe this is even more intuitive to explain is that in this situation, the scoreline is tied. Team A hit the post. If the goal is in, then now team A is in the lead. So it's much more likely that team A is going to win. And on the contrary, it's less likely that there will be a draw. So this market is less going to be likely. And on these 2 markets, once again, you'll have underreaction. So the underreaction is going to be on markets where the possible goal is going to change the outcome of the match toward the end. It's in the last 15 minutes each time. And this is a situation where team A was behind and losing. This is the market team A is losing. And so by scoring, team A is not losing anymore, team A is drawing. And here's a situation when team A is drawing, and by scoring now team A wins and team A is not drawing anymore. So the biggest interaction are toward the end of the game where a goal has an effect, a likely effect on the final outcome, whether team A wins or team A draw or team A loses. All the other situations basically are situations where team A is here team A is trailing by a lot, and so scoring doesn't change anything. Team A is winning by a lot, so scoring doesn't change anything. And you don't have underreaction in these cases. If we want to look at the characteristics of the situations with underreactions, we see that where you have underreaction situation, the most underreaction situation when you have a large volume exchange, and the average change in price is large because it's at the end. So at the end you have huge volume exchange, and the effect on the prices here is going to be huge. For instance, if you remember the Nuremberg, maybe I should go back to this thing, the initial.
Lionel, just a quick reminder, you have a couple of minutes.
Yeah, I'm almost. I know, I'm almost finished. So I wanted to go back to the Nuremberg graph. This is that. So you can see that the movements of the prices after a goal are much larger toward the end when they change the outcome here than toward the beginning. Okay, and so what we find is that you have more volume exchange here and more price change, and that's where you have underreaction. That's the basic insight. So now I can actually, I'm on time to conclude. And then we find two things. We find that market prices react very well to new information most of the time. I mean, to us, that was a surprise because we were expecting some like more general type of bias from this kind of setup. But what we find is that in the last minutes of the asset's life, when large information shocks create large variations in the asset's value, the price tends to underreact. So our conjecture here is that the explanation comes from the type of market structure of binary option markets. Ottaviani and Sorensen in 2015 have a theoretical model where they say that on a binary option market, if traders have budget constrained and they have different priors, then there will be underreaction to information. And intuitively, you can think that if you have a shock of information, then some traders with different priors will buy against information. But if there's and some traders with the priors will buy in the direction of the information, but there will be a kind of opposition between traders with different priors. And if they are budget constrained, eventually some will run out of their budget. And so not necessarily all the information can be reflected in the price. And what we observe is because we observe the end direction at the end, when you have large informational shocks with large volume, we conjecture that maybe what happens is that on these markets is a situation when these large informational shocks hit the budget constraint of the traders. We're toward the end of the match, maybe you have gambled a lot. And when this huge informational shock comes, even if you think that you would be willing to buy higher, maybe you're not willing to take even more risk. Maybe you have already a lot of assets in your portfolio, and you don't want to take too much risk on this specific market. And as a consequence, people don't buy fully up to their beliefs because they are a bit budget constrained, and that would mean that the information is not fully incorporated in the prices. Which would suggest, which is interesting as a result, which is meaningful for markets in general, that it's a case where these underreactions may possibly not be a behavioral phenomenon, but due to market structure. And that's my conclusion. And I thank you very much for your comments and for the discussion.
All right, we have time for one more question, perhaps. Anyone wants to
make a quick comment?
Yeah. Go.
So very interesting presentation, Lionel. So it's very interesting that you find that information is adjusted very efficiently. I'm sure that Eugene Fama would love your paper.
Yeah.
But Richard Thaler would say that precisely because you're dealing in a market where you have binary outcomes and you can measure the outcome very well in an expectation sense, and also because the dissemination of news is unambiguous. There's no issue of incredible news, and there's no issue of insider trading, etc. Precisely because of these issues, you don't have phenomena like underreaction, overreaction, which you see in equity valuation models, because there, as you said, you inherently have a lot of ambiguity, and that may in fact be the reason why you see substantial under and overreaction. I think that goes very well with your last point, that it's not a behavioral phenomena, but probably due to the market structure. So maybe you've already incorporated that in your paper. But just a point I thought is worth mentioning, that this is because of the market structure that you're dealing with.
Interesting. That's a good point. Yeah. Thank you very much.
You had something? Chris, did you have something?
Yeah, just very quickly. I would exclude corners. I'm just thinking, if you've got an in-swinging ball in football, it's much more likely to go in off the post, much more likely. And so, a lot of corners are in-swinging corners, right? So, I would just exclude them. If you've got no idea about what type of shot was taken, at least you can do something by excluding or including the corners. That's the only thing I think.
So I think we did that, Chris, I think we did that. So we excluded all the type of free kicks. We don't include penalties and free kicks. And that includes corners.
Yeah, no, fair enough. That's fair enough. Thank you.
All right. So sadly, I'll have to interrupt and conclude the seminar here. Please join me in thanking Lionel for a brilliant talk. Thank you, Lionel. And hopefully next time we'll see you in person here in Perth.
That would be great. Thank you very much for the invitation.
Thank you.
For your comments.
Thank you.
Thank you.
Bye, everybody.
Bye.
Bye, Lionel.